Recording in progress.
Good afternoon, everyone. I'm Janet Wright with the FSA Outreach Office. Thank you for joining us today for the Pandemic Assistance Revenue Program Application Webinar. We have with us today JC Hobb and Adam Kantovich, and they will walk us through best practices for completing the PARP application. During this webinar, you will be able to enter your questions into the Q&A box, and the presenters will answer as many as they can during this session. The slide deck will be emailed to all registrants in the next couple of days, and the recording will be posted to pharmacs.gov/taxes in about 2 weeks. And so with those housekeeping items taken care of, I'm going to turn it over to JC.
Thank you, Janet. So today's session, as mentioned, we're going to be talking about the tax issues and the application process for getting PARP benefits. This material was put together with the three of us, Ruby Ward from Utah State University, myself from Oklahoma State University, and then Guido Vanderhoven from North Carolina State. He's retired from there, so he's emeritus status. And Ruby and Guido both bailed on me, so you're stuck with me today in this discussion. So our group, we're primarily designed, or our goal is tax education and material development. Our group is called we're part of the National Farm Income Tax Extension Committee. And by being with this, we've also developed a website that's hosted by Utah State. It's called ruletax.org, which contains a variety of tax material, tax education material, webinars, fact sheets, Excel spreadsheets, etc., looking at various tax items. A few of these listed here: disaster weather losses, government program payments, etc. A great website, a lot more information in terms of tax topics and fact sheets than what we've discussed here or listed here. Visit our website. Great information, good, timely information, and we do our best to provide this in a simplified manners, much easier to understand than reading the tax code. Acknowledgement, basically saying that our work is supported by USDA under an agreement. There's the agreement number and information. So they're supporting us to help provide you with tax information. Again, our goal is education and materials. Also, remember, our findings, opinions, etc., are those of the authors, of the presenters, and not necessarily reflect the views of USDA. But we are doing our best to make sure that all of our information is accurate and up to date. Here's the topics that we'll be covering today. We're going to be looking at where farm information is located in our tax return. So looking at farm information on the various forms in the return. We'll be talking about the Schedule F and the Form 4797, giving you an overview of those two forms, because that's where the majority of the information that we're going to be using today is going to come from. We're going to walk you through how to extract detailed information from those. We'll also be introducing the forms, the FSA 1122, the FSA 1122A, and an overview of the form FSA 1123. So we're going to be talking about those, describing what's there, how they fit, etc. Then we've developed a farm example. And our farm example, we're making sure that we met the needs of PARP. So we've got a benefit year, or benchmark year, consider then the pandemic year, how we get that information off of the tax forms, and how we get it into the FSA 1122. Now, for our example, we did not use the 1122A, but we'll talk about it as well. Also, we'll have resources available towards the end, items to to discuss and consider, and then a Q&A at the very end. So our goal is to provide a lot of good information during this session. So the Pandemic Assistance Revenue Program. Some things to remember. This is a calendar year based program. So we're looking at calendar year based calculations from filed income tax returns. Or that also can come from if a tax return was not necessary to be filed, but you would still qualify. So it comes from the income tax returns. And you've got to remember, if you weren't required to file a Schedule F, but you were a farmer, you can and do have the ability to apply for PARP. Some of the situations where you may not have to apply or file a tax return is your adjusted gross income is less than the basic exemption, your standard deduction rather. If it's below that, you do not have to file a tax return for that year. So keep in mind, work with a tax professional. If you didn't file a return, you still may qualify. The second bullet, this does not look at crop program years. Again, remember the first line. It's calendar year based calculations. We're going to use the amounts found on the tax return. We're going to use the your selected benchmark year, 2018 or 19, and the pandemic year 2020. So you're going to look at one of the returns for either 18 or 19 and compare that information to the information for the pandemic year, the 2020 returns. So again, we're looking at Schedule F and Form 4797 to gather that information. So remember, we're looking at those basic pieces, but all of our farm income may not be, and usually is not, all on Schedule F. So there's some things that we're going to look at where you want to get additional information, additional clarification of those numbers. Something to remember, keep in mind, over 98% of our farm returns are filed using the cash accounting method, but we do have 2% of the returns that come in that are filed using accrual-based accounting. And we're going to walk through at the very end, or towards the end rather, how to make those adjustments, because we feel it's important to understand that even though you're on an accrual-based system, there are some cash information items there, and we've got to pull those away from the accrual adjustments. So we're going to have information processes that work for all farm operators, whether they file cash or accrual. The Schedule F, that's our farming activities. That's where we report those, farm business activities. Then we are going to look at Form 4797. That is for sale of business property. On that form, we'll find raised breeding livestock sales. It would also report dairy and draft animal sales. So we're going to walk through the process of how to pull those numbers out, where you're going to find them, how to adjust them, where they come into play. Also, Schedule F, sometimes we report some value-added products, ag tourism, etc. And when we get into those, there's some rules that we typically follow. One of the things we look at is de minimis rules. In other words, if the amount of income from value-added or ag tourism, etc., is a very small percent of the total gross farm income, we can typically lump it into Schedule F and leave it there. Sometimes, though, when it gets significant, we may want to split those out. The tax rules say we're supposed to split those out and move them to Schedule C. Well, a rule of thumb, and this is not a hard and fast rule of thumb, but a rule of thumb that they typically allow, IRS allows, is 5%. So if the gross revenue from our value-added items, ag tourism, is 5% or less of our total gross farm income, leave it on Schedule F. Again, this is not a hard and fast rule. There's nothing set in stone from IRS in terms of the tax code to give us guidance. We're doing our best to kind of using common sense as to how to play it in here. So when you look at this process, we have to have clear communication between the farm operator and the tax professional. Because we got to look at the farm operation, making sure that we understand all the income and expense items that come into play. Now remember, PARP is a revenue-based program, so we can throw out the expenses. Also, we can't get a complete picture from just a tax return. Additional records, additional information is needed. So communicating with the tax professional, it's very important when we start to look at completing the application and all the information from the tax return as well. Now, one thing that comes into play here, I said that a good majority of our farms, 98% sole proprietorships, filing Schedule F. Well, there's another piece of here. If your farm is either a partnership or a sub-S corporation, partnerships would file on Form 1065, a sub-S corporation on a Form 1120S. So they won't have a Schedule F per se, but a tax preparer sometimes will put together the Schedule F that helps in preparing that information that goes into the return for those two different types of entities. In this scenario, if you've got an S Corp or a partnership, it becomes more critical to work with your preparer to make sure that those numbers are pulled correctly into the application form. So 85% of our farms are sole proprietors. About 15% fall into this area of either partnerships or some type of a corporate status, S Corp primarily, sometimes even LLCs, taxed as S Corps. The Schedule F versus Schedule C. We talked about the de minimis items. The Schedule F looks at sales from the farm at their first sellable point. Good example would be milk. As long as it's raw milk, that's its first sellable point. But if we turn that into cheese, then we've got a value-added process that moves to Schedule C. So if it's sold in its original state, or if that de minimis value kicks in, again, our rules, basically 5% or less of the gross income or gross revenue, then we can report everything on the Schedule F. That is farm revenue reporting there. Schedule C is not farm income. So value-added ag products, strawberry jam, strawberries into jam, etc., ag tourism activities, these types of things. But remember, reiterate, de minimis. If it's small enough, leave them on F. So where do those go? Again, first value, sellable point is on the F. Reasonable values if there are things that go from F to a C. Let's go through that. So let's say we've got strawberries and we're raising strawberries. We sell some strawberries on the farm, but we also take some of those strawberries, we turn them into jam and sell them a different method. So we have value added. The strawberries that we take from our farm, from the Schedule F, and we move to a Schedule C, we report it as income on the F, and it's an expense on Schedule C. Again, there's no hard and fast rules on how that's valued. A reasonable value should be applied. That could be the cost of production, could be what you would have sold those for if they would have gone straight to the market versus being processed into jam. Again, there's no hard and fast rules. Be nice if there were times, but the real issue comes back to making sure you have documented your information, documented the value, and be sure to keep that documentation handy with the tax return, just in case that they're ever asked or audited. Now, also may not have done everything in this way that we just presented. Again, look at the farm records, ask questions, work with your preparer. You can get, again, back to these numbers. So how do we use the information for the PARP application? Well, again, we're looking at Schedule F. That's the profit and loss from farming. That's the primary point. That's the beginning point. Then we have the 4797. That's the sales of business property. So that can be machinery, equipment, can be land, breeding animals, etc. We'll go through those in more detail. Farm records, the FSA 1122 and 22A, and then the FSA Form 1123. And we're going to use an example farm operation on how to calculate the input values for these two for the USDA Form FSA 1122. Like I said, we're not using the 1122A, and I'll explain more in a moment. Janet, are there any questions before we jump into the details of the F?
Yes, we do have a few. The first one, excuse me, if I have a Schedule F that has accrual adjustments, all cash, but includes inventory adjustments, do I include those in gross income calculations or look at it like a cash Schedule F?
We're going to get into that, and I will explain that question and explain the answer to that question in detail.
Okay,
Good question, but just a little early on. But I
okay.
will walk through that process.
Okay, so the next question is for the crop insurance proceeds, do you deduct crop insurance premiums reported on line 20 of Schedule F?
On 20, that's the expense items. No, we're only looking at lines 1 through 9, and we'll get into that as well.
Okay, what about entities that file income taxes based on a fiscal year, not a calendar year?
Okay, so the 12 months, the way I understand it, and I think your FAQs kind of lead us to this as well, that you're looking at a 12-month period, even though it's fiscal year, that is the tax accounting year. So the question then becomes, do we adjust back to getting it from January 1 to December? I think that's going to be a question that we're going to need to bring back to you, to the USDA FSA office, and make sure that we truly look at what PARP wants. Is it truly a calendar year, or is we looking at a 12-month tax year? So I'm not sure exactly. They're going to need to visit with you for more detail.
Okay. And so the last question for right now is, what about Form 4835?
4835, I believe that's a cash rental form.
That is the farm rental income and expenses. That's correct.
So that's going to flow in. So if you've got, that would be a participating rental operation. That's going to be treated somewhat very similar to the Schedule F. The income from that is also included. We didn't bring that into play. I guess we kind of failed to think about that. But yes, the income revenue that shows up on that form will also be an adjustment to the F and 4797 information that's included here. So yes, it's includable, but looking at only the revenue side. Okay, let's continue on. So here we have the Schedule F, and this will point out some of those questions, answers to some of those questions. What we've got here, and we're going to get into more detail of just part 1 in a moment, but this is the full information that's concerned on the Schedule F. And what you really want to do is, when you're looking at this, is having the instructions to the FSA 1122 handy, because you're going to have to make some adjustments, and you want to make sure you follow the instructions that are on the back page of the Form 1122, because it gives some more detail of what we need to be looking at. So our farm records that may need to help be brought into play would be the records needed to explain the cooperative distributions. That's lines 3A and 3B. Basically, in those situations, you may have some non-farm purchases that you get a patronage dividend for. Those non-farm items aren't really allowed, or are not taxable, rather. They're allowed, but they're not taxable. So we exclude them on 4B, or 3B, which is the taxable amount. Then we have ag program payments. They show up on 4A and 4B. The total amounts in 4A, the taxable amounts in 4B. So if we've taken out a loan on crops, things like this, and market gain occurs, market gains usually reported in 1 year, and consequently, the taxable amount would be in the following year. So you didn't want to double count that. So you'll make an adjustment from 4A to 4B, taking that out so that we do not double count and get taxed on that income twice. CCC loan elections, kind of the same thing. That's 5A through 5C. Working through those, whether we make a loan reported under election, loans forfeited, again, the taxable amounts that show up either 5A or 5C is what we want to report and account for the PARP application. Crop insurance, kind of the same thing. Amount we received, again, this is for the tax year 2022 or 2019 for the disaster year, or benchmark year 2020 for the PARP or the pandemic year. So when we get into those, we'll walk through how that insurance elections occur, how to make sure that we get the taxable portion in the right spot, and then other income that shows up in line 8, whether, again, going back to the instructions, it points out what is includable in line 8 and what items should be excluded from the amount in line 8. With those, then we make the adjustments and then we move into the application. Then we have Form 4797. Again, the sales of business property. We're looking at, according to PARP instructions, breeding animals that were raised. And this can be also dairy or draft livestock. Those items are reported on Part 1 of line 2, Part 1, line 2, if the animals were held for more than 24 months. Now, this is looking at primarily cows, would apply to those rules. If we're looking at other breeding livestock, remember, maybe we have to hold them for more than 12 months, 1 year. Part 2, we have to include these items as well. The total amount of animals sold at Part 2 would be basically, in our example, we're going to use heifers that are culled. It's animals that would be going, or we were hoping to put either into our dairy or our breeding herd. These animals proved not to be worthy. They were pulled out. We were held them a little longer, trying to find out whether they would be useful. They did not make it. So if they're held for 24 months or less for cows, 12 months or less for other breeding livestock, then those sales are reported in Part 2 on line 10, and that total then is included in the calculation for PARP. So here's the Form 1122. I broke this apart in a little bit so we can get it on the screen, but here's Part A. Part A is basically where you put your basic information in and understand the producer agreement. So be sure you read Part A very closely. Then we get into Part 2, or Parts B through E rather. This is the bottom half of page 1. This is where your information goes in, your name, address, other items, phone number, then our calculated allowable gross revenue for either the 2018 year or 2019, whichever one we decide to use for our benchmark year. And remember, it's allowable gross revenue, not net, gross. That's why we're only looking at Schedule F, the top 9 lines. Then on box 8, the 2020, that's the pandemic year. Again, allowable gross revenue. So it's important to remember, we're not taking into consideration expenses. So in our example, we're going to be using 19 as our benchmark. And again, 2020 will be the pandemic year. Here's the second page, page 2. Again, broken into 2 parts. So there could be some run on here, but the 1122, page 2, is our instructions. What is going to be allowed as gross revenue? What are those sources? Basically, what are we going to include and what are we going to exclude when we're trying to determine that allowable gross revenue? So look at column 1. That is the allowable side, what gross revenue includes. Column 2 is what it excludes. And these are very comprehensive. USDA has done a great job of telling us what to exclude and what to make sure is included. As of this presentation, I was told that this form is being revised. Hopefully be revised fairly soon. So basically there's some additional items here that are going to be added to or discussed in more detail in the revision that's coming out. So be prepared, watch for it. Here's the bottom half. So you'll notice the top half will have about lines 1 through 4 in great detail on the inclusions. So here's the last part of it. Again, what's included on the left, what is excluded on the right. And like I said, it's very explicit as to what you leave in and what you take out. Now, something to remember, and we had a discussion with USDA on this, some of our folks that were helping provide guidance to us when we were putting this presentation together. Some of the things that we know that, for example, the ERP program, you may have received, not necessarily have received, but you may receive that payment early or before you file this return or information. If you receive it, USDA will take that out for you. You don't have to make that adjustment. So be sure to note what has been removed when you make the application. Again, this is being revised to help explain those types of items in greater detail. So here's the 1122A. This is not one we're using because our assumption in this, our producer that we're dealing with is a experienced, established producer. He's not going to be new to 2020. If they were new to 2019, or they don't have a full year's revenue, they're going to use Part C. If there's an increase in the operation, overall scope or size of the operation, then you fill out Part D. Again, for our example, we made the assumption that this was not going to apply, so we didn't fill out the 1122A. And on the backside is also the instructions of what to include, exclude, what to look at, how to fill out the form correctly. So when you're looking at these things, front page is great, gives you the information, the application, the backside has the instructions. The next form that applies is the 1123. When we have adjusted gross income that reaches a certain threshold, we're going to need to file the 1123. Basically, it's used by persons or entities that exceed the average adjusted gross income threshold of $900,000. That's the average, $900,000 for tax years 2016 through 2018. So if the average for the 3 years is greater than 900,000, then you've got to file the form FSA 1123. You'll notice here in the discussion certification rules, a licensed CPA or attorney must certify that the average adjusted gross income for 2020 program year exceeds the limit, the 900,000 threshold. Certify that the 2020 tax year adjusted gross income 900,000 or less, and certified other items that are considered there on page 2 as well. So the issue then becomes, once we hit that $900,000 threshold, we're going to have to get us a CPA or attorney that's going to look through this. The issues come back to, well, certain areas and the rural parts of farmland or farm belt, a lot of times we don't have CPAs or attorneys that are handy to us. Remember, this hits you, you're going to have to get that done. It's going to can be fairly costly. Again, a licensed CPA or attorney, they're not cheap. They're going to be basically going through and developing or analyzing those tax returns, not necessarily a full-blown audit, but they're going to have to verify those numbers are accurate and correct. They're not going to want to sign off on the bottom line without them knowing and feeling comfortable with the information that's provided here. So again, their due diligence as prescribed by IRS and the Bar Association, as well as the Society of CPAs, requires their due diligence in looking this over, going through it in detail, making sure things are right before they sign off on that information. Janet, any more questions to this point before we get into the example?
Yes, we have some. So the first is, would a vineyard report grapes on Schedule F and wine on Schedule C?
That would be correct.
Okay, the next one is, a husband and wife have separate farms as far as FSA, but file taxes jointly. How do they file the FSA form?
That one I'm going to turn back to FSA. To me, I think it's going to be a rule that you're going to have to look at from the USDA FSA side to make sure that they're meeting your needs, because if they've got separate Schedule Fs, I don't know whether you're going to allow them to file that application separately or whether you're going to have them combine it. So I'm going to push that one back to you, if you don't mind.
Okay,
Sure.
Michael just popped up.
Yeah, I mean, I guess I have a little bit more and deeper question of why are they filing separately with FSA and then is one as the tax return. But I think in general terms, I can say they should be able to continue to do business as they have done business with FSA, but they would have to have the appropriate breakout of that income and revenue for those years to align with the inputs of each one of those spouses if there's something other than the simple 50-50.
I would say here that we may have the situation, and this just now popped up after you started in, of a qualified joint venture. Qualified joint venture, husband and wife would each file their own separate Fs, but it would be brought together in the final tax return. So they might file one single 1040, but the Schedule Fs would be separate for him and for her, for husband and for wife.
And that would make sense, and that would be consistent with how they normally would do business with FSA, and then that's how they would do their PARP application.
I'm pretty sure that's the answer to that question. Thank you.
Okay, the next question is, instead of a Schedule F, the farm income is located on the 1120-S. Would the appropriate tax line be 1A gross receipts or sales, or tax line 3 gross profit for the income?
I'm going to have to, you're going to need to put that one into a, hopefully they've got an email, or you can email that to me. I'd like to look at that in a little more detail on the 1120-S to make sure that I'm understanding. I'm off the top of my head, I would hate to jump in on that without having the form sitting in front of me.
Okay, fair
So
enough.
I'm going to postpone answering that. I will answer that via email later on. Thank you.
Okay. And the last one we're going to take for right now is, if you have purchased cows or bulls and they have been depreciated, those would be reported on Part 3 of 4797. Are those also included in revenue?
Those are not included in revenue for PARP because it's raised animals that were allowed, but they are reported in the right spot. They are reported on schedule Part 3 of the 4797. But the only piece that we've got to look at for the PARP application is lines 1, or I believe that whatever it was, line I guess line 2 and line 10. So Part 1, line 2, and Part 2, line 10 are the only things that's going to show up from the Form 4797 in the PARP application. Are we ready to continue?
Yes.
So then we're going to get into the example. Now this example, when the three of us, that's Ruby, Guido, and myself, started looking at this, we felt like an example operation was necessary to help fill out and answer some of these questions. So fill out the 1122 and answer many of the questions that come from, well, where's the information coming from on the Schedule F, as well as the 4797. So we've got this Will Farmer. He is a sole proprietor. His farm operation is a traditional operation in the Midwest. We've got livestock and crops. We used, as in our information, the Kansas Farm Management Association farm data as a source of getting good representative numbers. So we have realistic numbers in our discussion here. So like I said, we've got a sole proprietorship. The Schedule F was repaired, and also the 4797. Now, remember what I said a little while ago. 85% of our farms are operated as sole proprietorships. So that leaves 15% as partnerships or sub-S corporations. With those, you're going to have to do a little more digging. Hopefully they did prepare, the tax return preparer did prepare a Schedule F, so it makes it a little easier to find the data. If not, you're going to be going back to the farm records. In our situation here, we've got Will Farmer. Will is making an application there on his traditional operation. He's using the 2020 pandemic year. His benchmark year is 2019. He did receive a $10,000 ERP payment in 2020, and we're going to walk you through how that comes into play and where and why and how it's treated. Let's get into some of the details. We're going to get into the weeds really deep here. So here's Will Farmer's Schedule F. This is part 1 for 2019. Again, remember, this is a place to start, but more than likely we're going to need to get into some records. Also remember, PARP, a revenue-based program. So we're not looking at expenses. So we're throwing out part 2. We're only looking at part 1, lines 1 through 9 for the application. Now, as I mentioned earlier, we'll do it again. Later on, I'll show you how these 9 lines also fit into the determination if you're accrual-based accounting. So let's get into what's going on here. So Will Farmer, he's got sales of livestock, other resale items, line 1A of 200,000. His cost basis in that livestock, as well as his grains, etc., 125,000. So when you subtract those two, we've got $75,000 of taxable income that shows up on 1C. That's the important number. That's the taxable amount. Line 2. So we've got livestock, produce, grains, other raised products of $255,550. Again, that's the taxable amount, the important part. Now let's look at the co-op distributions. So he got a Form 1099 patronage from his co-op. That showed his total patronage dividends of $223,200. Going back to what was on that patronage form, it showed that he had about $1,500 of $1,300, I guess, of non-business expense or purchases. This could be in the co-op where I grew up, they have a deli. You can go in and get a sandwich, but you get paid a patronage based upon what you purchase there for meals. This is not taxable. That's personal items. Those are allowed to be reduced. So our taxable portion is $222,900. So those personal items come out. So we have to make an adjustment here. So 3B. Now we have ag program payments that show up on line 4A and 4B. Here we have those payments. What we did in this scenario is we had some sales. We had some grain that we put into a loan. And what happened we had some market gain on that occurred in the prior year, 2018. So we received $5,000 of market gain that was reported in 2018, but we don't want to report it again in 2019. So we make an adjustment from 4A to 4B for that $5,000 that was reported in the prior year. Again, we have to adjust accordingly. We don't want to pay tax on it twice. 5A, Commodity Credit Corporation loans. In this situation with Will, he made a loan, he elected to treat that as income. So a CCC loan elected to be treated as income for 2019, then shows up in line 5A, fully taxable in 2019. So income, that loan treated as elected as income, that election can be made or revoked annually. So what we do one year, we can do something different for the following year. We didn't forfeit the loan, so therefore we didn't have anything in line B. So 5C is blank. Then we get into crop insurance. Crop insurance proceeds, disaster payments. These provide an interesting piece of the puzzle. Remember, the crop insurance and disaster payments, depending upon what goes on in a farmer's normal situation of marketing, reporting sales, etc., can dictate whether or not he can defer all or part of that income from the year received into the following year. Well, in 2019, for Will, he received $19,100. It's all taxable in 2019. If in his normal situation of marketing, if Will would normally have sold 50% or more of his crops that he raised in 2019 and sold them in 2020, then we can defer the part of that insurance payment or disaster payment that would normally have resulted from those crops being sold in the following year. So we've got to look at and remember crop insurance proceeds, disaster payments. There is the chance to defer those if it is elected and if the farmer qualifies again, selling 50% or more of that crop in the following year. Line 7, custom hire. We got $12,900. Other income, this is a fuel tax credit, but it could be some other things as well, $3,100, to give us our total gross income of $748,750 from the Schedule F. So that's the first part of the adjustments or pieces that go into the form, application form 1122. Now let's play with the 4797. So here we've got the cull cows. They were long-term investments that were held more than the 24 months. Consequently, the gross sale price, there's no depreciation allowed because they were raised. That full $16,640 from the sale of those cull cows is taxable. So we're looking at the total of lines 2. Since I only had one line here, that's very simple for us. Could it be 3 or 4 lines you may have, depending upon how many times a year you market cull cows or cull breeding livestock. Again, remember, these are raised that show up here in part 1. If you purchased them and they're depreciable, they will show up on part 3. We're looking at raised animals as per the PARP requirements. Then we go down to part 2. These are cull heifers. For breeding beef animals, that's held 24 months or less. If it's other breeding animals such as goats or sheep, 1 year. So if they're held 1 year or less, then they fall in part 2. Goats held 12 months or more fall into part 1, line 2. So those 2 adjustments, the 5,000 and the 16,640, will then be used in the application. Now remember, these are the benchmark year numbers. Then we get into the pandemic year, 2020. So we're going to look at the Schedule F and make the same kinds of adjustments, the same things that come into play. Now, one thing we'll notice, the pandemic year, there were some other problems that occurred, so our values are going to drop, weather, prices, etc. So in the pandemic year, our line 9, 536,000 compared to the 757,490 for 2019. Pretty significant drop. Pretty much the same items that we're looking at. 1C, that's the sale of livestock, just without the basis coming in there. That's 85,000. Then we go look at raised animals, 179,500. Co-op distributions, again, we had some non-farm items in those patronage dividends. So the $123,000 less than what was the reported on line 3A. The ag program payments, we did the same thing. We had a loan there and or market gain rather, 5,000. Consequently, the total amount was 63. The taxable amount's 58,000. Our production was less, so we had no commodity credit loans that came into play. So 5A and 5C are blank. Crop insurance, a little larger amount due to the production problem, 65,000. His custom hire, 4,500. His other income, there was some state fuel credit or gasoline credit. And there was also a state grant that he applied for and received that is taxable. So his gross income, summing all those numbers together, is 536,000. Now we adjust for 4797, parts 1 and 2. Again, due to the problems with weather, etc., we had some more sales. Cull cow sales went up, 30,303. Cull heifers are 4,500. Now again, we're only dealing with lines 2 and lines 10. Nothing else off the 4797. Let's kind of recap real quickly. What goes into gross revenue? Again, that's Schedule F. Those are totals of various line numbers. Those are on the right-hand side of the thing, the taxable amounts. Remember line 2, there could have some de minimis values in here. If so, they're allowed. Also on the page 2 of the form FSA 1122, there's guidance as to what we should remove from calculations. The ERP payment that we received, that 10,000, we were told that FSA will make adjustments for that, so you don't have to remove that on your own. So there are certain things that they're going to fix that you don't have to include. My comment here is, when you put together the application, you might want to add an extra page explaining what numbers went into those calculations from your point of view. That way you make sure that you are not penalized for having removed it yourself, and then USDA removing it as well. Just a thought. Then we get into 4797. That's the business asset sales. We're only going to include sales of raised breeding animals, dairy and draft. That's part 1 of line 2. So part 1, line 2 numbers, part 2, line 10 numbers. The sum of those items on those 2 sets of lines. Now here, what I've done here is kind of laid out the Schedule F for 2019 and the PARP application numbers on the left-hand side for 2019. Those are in the green. And then in the kind of goofy looking blue, the 2020 Schedule F numbers, and then the 2020 allowable gross revenue numbers for the PARP 1122 application. So let's go through those. You can kind of see, if you're looking at the Schedule F, those numbers From 1C, the 75,000, that's 100% allowable. The line 2, fully allowable. Co-op distributions, 3A, I'll show you what happens. We take out the personal items, that drops it down to 222,900, not to 223,200. Ag program payments, that was at market gain, so the allowable portion for the application is 60,200. The CCC loans under election that treated as income, all of that's allowable. Crop insurance is fully allowable. Now, custom hire, when you look at the form, the 1122, turn it over, look at the instructions, line 7 items are excluded completely. Custom hire income, anything that would show up in there, no, not allowed. Other income, line 8, the fuel credit's going to be fully allowed. So we get a final number in the green column, the second one, of $735,850. That is the box 7 amount from a Schedule F. Now remember, we've got to take into consideration 4797 adjustments. And we'll show you how to do that in just a moment. Going over to the 2020 numbers, the pandemic year, the same kind of scenarios apply. We have the patronage dividend being adjusted by $1,000. The ag program payments, 58,000. That's reported because of the 5,000 market gain that came in the prior year. We don't want to tax it twice. Crop insurance proceeds fully allowed, 65,000. The fuel credit plus the state grant, 21,000. So our box 8 number from the Schedule F is 531,500. Again, remember, this is not, you're going to have to go further if there is 4797 that applies. Now here comes the adjustments as they would come from the 4797. So you'll notice that I've got Schedule F numbers first, modified just gross income from there, 2019, 735,850, 2020, 531,500. Then our breeding animal sales, we're going to include the total amount from line 2 for each 2019 and 2020. And then also line 10 for 2019 and 2020. So our allowable gross revenue that goes into FSA form 1122, that application, the first box for the benchmark year 2019, total amount 757,490. 2020 pandemic year 556,300. And just for your benefit, I went ahead and calculated the percentage decline to show that we definitely meet it with will situation. Remember, the rules are 15%. Well, we're well above that 15%. So again, here's how you go about making those adjustments back to from the 4797, the Schedule F, and how we get the final number that goes onto the application form itself. So here's what the application form looks like. I've modified it a little bit. I left part 1 and pulled it down. So really what we're trying to deal with, remember where we put the right numbers in, it's the gross revenue, part C, 757, 2019, that's the allowable gross revenue. Benchmark year, 2020, 556,300. We're going to sign the form. Now, remember, the 1122 is self-certified, doesn't require a CPA or attorney. Certification is done by you when you fill it out. Everything's good. So once signed, dated, rated mail in, return in. So here's the, remember, recap the adjustments. Go back to the form 1122, FSA 1122, page 2 for the details. For our adjustments that we made for Will, that's lines 3A and 3B. That's the 1099 patronage. For his return, we had to go back to the farm records. 5A, B, and C, again, these were loans elected to be treated as income. They weren't treated as a loan. They weren't forfeited. So consequently, the loans were forfeited and not repaid. So we have that treated as income, boom, shows up on 5A. Line 7, custom hire has to be removed. Line 8, you're going to have to look at items related to production of commodities. In the 4797, raised is the key word here. Raised breeding animals, raised livestock. So those animals, again, the income from those reported on lines 2 and 10 of the 4797. Now, big red letters at the bottom. Be sure to review page 2 of the 1122 for guidance. Make sure you look at that very closely. Don't make any mistakes. Don't include things that shouldn't be. Don't exclude or include the things that should be and exclude things that shouldn't be. Now, as I mentioned early on, we have 2% of our farm operations using accrual accounting. What happens? We have to make some adjustments because the gross income that's reported on line 9, if you're an accrual basis taxpayer, will not be the true revenue that goes into the PARP application because its focus is on cash basis. And I'll show you where that came from in a moment. So when we start looking at part 3 for the accrual reported accounting for the farm, you'll notice what I've done on the right-hand side is I've actually put the line numbers that do apply. So for line 37, the accrual adjustment or the accrual reported numbers here, these first few lines are cash lines. That's going to be the information for lines 1A, B, C plus line 2. So the taxable portion is line 2, 1C plus line 2. Cooperative distributions, 38A. Well, that's exactly line 3A on the front of the Schedule F. So those two lines coordinate. The instructions will be the same. Taxable amount, 3B. Program payments, 4A and 4B. CCC loans, under election, 5A. Forfeited, 5B. The taxable amounts, 5C. Crop insurance, 6, line 6. Custom hire, line 7. Other income, line 8. Line 44 is the sum of lines 37 through 43. These are cash revenue items. So if you're looking at doing an accrual method, if you're using the accrual method of accounting, paying taxes on the accrual method, this line 44 is the amount used in line 9. So line 44 is used as allowable gross revenue on FSA 1122, not line 50. Because lines 45, 46, 47, 48, those are the accrual adjustments. Those are not cash. They do not qualify. So therefore, line 50 is not used. It's line 44. So highlight that, mark that. That's the one you're using. So to answer your question, which I hope I just did for the person that asked about the accrual accounting, it's line 44 that you use, not line 50. So the cash basis, this is the reason that I pulled all that out. If you look at the PARP fact sheet on page 2, the very last section that's written in there talks about allowable gross revenue. And it basically states it's all revenue a producer received on a cash basis method. Therefore, like I said, if you're looking at accrual, you take those accrual adjustments out. You go back and look at page 2 of the fact sheet. It specifies in there, we're looking at cash basis information. These are the 2 paragraphs in that fact sheet that point this out. So that's why I went ahead and put it in here. This is the basis for that discussion, previous discussion. So like I said, it's a calendar year, not a crop year. You're going to use the FSA 1122 instructions, follow those closely. There is a USDA pandemic revenue program tool that helps with the calculations. It's a very helpful and useful tool. It works. You'll find it. I've got a link to it here in just a moment. You're going to post the allowable entries from the tool to the 1122. You're going to sign and date it and turn it in. If 1122A and 1123 are needed, complete those forms. But like I said, for our example, we only looked at the 1122. So 1123, remember, that's when the AGI exceeds a $900,000 limit. You're going to file that waiver, 1123. You're going to have the income that's going to be looked at by a certified CPA or attorney. This is required by statute. It's not USDA policy. So by statute, you have to do this. In a very rural areas, it could be kind of problematic to get a certified CPA or attorney. You may have to travel a ways to get that done, but it is very well worth it. In Will's example, the farmer example, the 1123, we didn't need it because we never reached that adjusted gross income threshold. His adjusted gross income was well below the 900,000. Here's a list of PARP resources. This is everything that I could find. I believe this was looked at by, well, I know it was looked at by the FSA folks. They'd added nothing to this. Be sure to look for the revised 1122. There's going to be, that's coming out fairly soon. So finding a farm tax expert's not easy. In our, on the website, farmers.gov, and also on rural tax, we have some information on how to choose a tax professional. There's also some other webinars on introducing ag taxes and USDA programs, farmers.gov. That's where we also talk about that, choosing a tax professional is in there. When you're looking for a person with expertise, look at their qualifications. Ask them to give you a list of people that they do returns for. Ask if they do farm returns, and then ask for some farmers that they do returns for. Ask them if they would be willing to tell you, are they having a good experience? Ask about the preparer's experience. Also ask about service fees. When are they available? Ask how to handle gray areas. Are they very conservative, very liberal? And what about limits on audit representation? Some of our accountants will do their tax return, but they may or may not represent you in an audit. And here's some tax resources, farmers.gov/taxes. There's some things there. Go to the website. You find webinars, links to materials, all kinds of interesting things. Also go to ruraltax.org, look at our tax topics. We have webinars there as well. And a lot of our land grant universities are involved in the extension programs. They have tax materials as well, plus agftap.org. So with that, let's move into questions. And if you have follow-up questions, send those to Janet. We're going to make her famous. She loves to answer these. And her email address is janet.wright@usda.gov. So with that, let's get into some questions and answers. Janet, did you leave me?
No, I did not leave you. I am getting us pulled up here, and I'm going to get, the first question is, if the patronage was based on sale of seed or fertilizer, does that count?
Yes. Fully counts. Feed and fertilizer, yes. That's production of commodities.
Okay, for insurance proceeds, if cash received in 2018 and a portion deferred for tax purposes to 2019, is the amount deferred to 2019 adjusted to be reflected as 2018 income for PARP?
No, it is not. You're only using the amount of that crop insurance proceeds from the year before that's reported in the current year. So anything happens in a prior year is not included when it comes to crop insurance. Only the amount of the crop insurance payment that shows up on either the 28 return, or I mean the 2018 return, 2019 for those benchmark years, or the 2020 pandemic year.
So JC, so for essentially it's whatever shows on that tax return, regardless of what year it came from. Is that what
That is correct. That is correct. It's looking at a calendar year number. Therefore, that's why anything that happened in the prior year that shows up on that return is not reported.
Okay. Is custom feeding from a cattle operation allowable in gross revenue?
Custom feeding.
Such as I own a feedlot and therefore I'm being paid a lot rent?
That, I think that would qualify. Let me do some digging on that one. Mark that with a little more detail and let me do some digging to make sure that I answer that one correctly as well. I'll get that answered. My goal is to have any questions that you send to me answered within a very short amount of time, 24 hours or less.
Okay, good deal.
But
So
I'm not
crop
willing to stick my neck out yet on that one.
Okay, so crop insurance is often deferred by the row crop farmers. Do we include the income in the year received or the year taxed? I think you pretty much just answered that.
Yeah, it's in the year that shows up on the tax return. So you're taxed.
How do you account for increase in acres on the PARP application?
Increase in acres, that's going to be you're going to fill out the form 1122A, Part D, because that's where we make adjustments in the farm operation size.
Okay. How does timber sale, CRP payments, and cash rent need to be excluded?
One more time.
How does timber sale, CRP payments, and cash rent? I think there's something missing here. I guess maybe does it need to be excluded?
Okay, if you look on the 1122, excludable items, timber sale is number 7. It's excluded. Cash rent excluded. They're very specific there. So if you have timber sales, you're going to go back to your return, look at it where it's ever reported, make sure that it's not included in the Schedule F items. It's going to come out differently. Most timber sales, I think, show up on the 1120 something Form T or something like that. But
The timber sales may show up in a number of places depending on who the individual is. So it could be just being found on the 4797. It could be found buried in Schedule F and or Form T, Schedule C, and Schedule, I think Schedule A.
yeah, if it shows up in F, that's one of those things you're going to have to pull out. So that's where it comes back to looking at your farm records. Again, we said Schedule F is a place to start. And that's really all it is. You're going to have to look at records and other items to substantiate those entries.
Okay, the next question is the $900,000 limit to file 1123. Is that the true AGI on the 1040 form and not the gross income on Schedule F line 9?
The way I understand that, that's the adjusted gross income from the front of the 1040.
Okay, and I think this is an FSA question. Can the signature on the FSA 1122 be digital?
Depends on what the definition of digital is. We working with the county office, this is one of the programs that we're trying to make all digital and all electronic. So we have our internal box in OneSpan, which folks can set up with a EOF level 2 account and go back and forth. outside of that, we accept a fax emailed signature. So, I feel like that's a really bad answer, but not fully understanding what they mean by digital. But most cases, yes. You fax it in, you email it in. Those are kind of the same thing at this point. If you use our box and one span method, that is also considered a digital signature as well. Like the Adobe signature, if you have the Adobe tool that writes in a digital signature, that's acceptable as well.
Okay, thank you, Michael. What determines whether 2018 or 2019 is used as the benchmark year?
Personal preference by the applicant.
Are seed sales included in allowable revenue?
Seed sales?
Yes.
Yes.
Okay, I'm going through it. Looks like we're getting to some duplicate questions here. So, one more, do you include payments received for no-till?
I'm assuming they're talking about custom hire payments received. That's custom hire is specifically excluded.
What happens if they're receiving payments for some type of program to have their land in no-till? Whether it's coming from a federal agency or even a state agency or third
That
party.
could be other income on line 8. And you have to look at it on a case-by-case basis. But what is talked about custom hire income very specifically is excluded.
Okay, and this is going to be our last question. How do you handle grant income?
Grants, there's talked about in that the 1122 question and answers, the instructions in table 1 on the back page. Grants are talked about on the I believe it's line or print 8. Payments issued through grant agreements, FSA, they're allowed. And then also there's other state and federal grants. It's talked about further down in that discussion of includable items that are also includable in the gross revenue. So you're going to have to kind of look at those and look at the grant. There's nothing specific as to which types of grants are allowed and which ones aren't. But for the most part, it does specify in there that grants, most state, and NOAA grants and state program funds, they look like they're to be includable as revenue.
Okay, well, thank you so much. And thank you, JC, Adam, and Michael for all joining us today and providing answers to the questions that came in. As I mentioned before, the slide deck for today will be mailed out in a couple of days for everyone who registered for this webinar. This recording will be posted in about 2 weeks on farmers.gov/taxes. And for the questions that were answered today, we will be compiling an FAQ that will be posted also on farmers.gov/taxes. And it will probably post around the 2-week mark, the same time as this recording. Individual questions that come into me, I will forward those immediately over to the team, and you will probably get those questions back a little sooner. So again, thank you all for joining us today.
Janet,
And yes,
please send me those 2 questions that today,
Yes.
if you would. I'll get those answered and back to you.
Okay, sounds good. Thank you all for joining us today, and we will see you next month, actually. Have a good one.
Thank you.